Today I'm going to explain about all the accounting principles. An accounting professional have diligently developed and adhered to the GAAP, which is generally accepted accounting principles to establish the most reliable method for recording financial transactions. It means that if you would like to record all the financial transactions, then you need to follow these rules. And these rules are known as the accounting principles. And these principles ensure that financial statements such as profit and loss account, balance sheet, statement of change in financial position, and statement of change in owner's equity, cash flow statements, all these financial statements are accurate and the investors or outsider worlds can have trust on it. It means trustworthy and allowing readers to confidently rely on the information presented. Now, I'm just going to explain 12 most important critical accounting principles covered in GAAP. So, with one example of each. The first one is the distinct business entity principle. What does it mean? It means the person who is running the business is separated from its business. This principle states that the business is separated from its owner or any other business entity. All business transactions should be recorded separately from the personal transaction. For example, the person is working in the same company in which he is also a boss, right? He can get salary from his own company. He is getting salary from the company which is owned by own business. Means that uh, at the time of filing income tax return, he has to file their corporation, means their company's income tax returns separately and their own individual income tax return separately. So this is known as separate entity concept or distinct business entity principle. Let's take one example. If the owner of the bakery uses their personal funds to purchase a car, this transaction should not be appear in the bakery's accounting record. This is also one of the example for to show that distinct business entity principle. Owner of the bakery is there that use their personal funds to purchase the car. It means that he is not using the business money to buy car for the bakery. So this transaction should not appear in the bakery's accounting record. It should appear in their personal accounting record. Mean that is for the personal transaction, not a business transaction, right? So always remember these transactions are totally different. Going concern principle assume that the business will continue to operate indefinitely unless there is a clear evidence to suggest otherwise. It means, for example, if the business has ongoing contract and future revenue streams, it will not record the full cost of long-term assets immediately. Instead, it will spread the cost over the asset's useful life as company is expected to continue operation. Here, it is like you can say uh, you can use the depreciation for the long period of time. Useful life of the assets is 5 years. And let's say laptop is $500. Divide by 5 is equal to $100 depreciation every year. So that is the cost of that assets that you are going to write on the profit and loss account debit side. Second meaning of this is going concern, that you are not considering that this business is just for 1 or 2 or 3 years, and this business is for the long period of time, indefinite period of time. This is the meaning of going concern. Monetary units, whatever that you are using here in the business, that will be used in the monetary form, in the dollar form, maybe any currency of any country. Only transactions that can be expressed in monetary term are recorded in the financial statement. It assumes a stable currency, typically the local currency. We are not using the cryptocurrency in this case. For example, a company record a purchase of raw material costing $10,000 but does not record the value of the employee morale, right? Even though it's valuable, because it cannot be expressed in dollar terms. Morale, their honesty, we cannot. It's valuable. Honesty is valuable, but we cannot express in dollar terms. Time period principle says that the business financial performance and position must be reported for a specific period of time or predefined period, maybe monthly, quarterly, or annually. A retail store must prepare financial statement at the end of every quarter to provide the snapshot of the financial health for that specific period. Normally, that accounting period starts from the 1st of January and end till the 31st of December, 1 year period. But in case of corporation, and at the time of starting off your own company or any company, if that you are going to start maybe in the month of October, first accounting return or period will be depends upon when you are going to file the corporate tax first time. Sometime this may be more than a year, sometime it may be less than a year. But once you decide the particular date, it will remain exactly the same date for the next upcoming years. And this happens in case of corporations or any business. Is known as a fiscal period. Cost principle says that whatever that you are going to buy, that will become the cost, and this is known as a historical cost. The principle dictates that the asset should be recorded at their original purchase price, not the current market value. For example, a company purchased a piece of machinery. The value of that machinery is $100,000 in 2010. Even if the machinery current value is 80,000, it has reduced. It will still be recorded at the original cost. If it is increased, even then this will be recorded at the original cost of $100,000 in the financial record. Consistency principle says that once the company choose accounting method, for example, FIFO, LIFO for the inventory, or maybe depreciation method, straight line method, or any other method, so it should continue to use that method consistently over the period of time unless a change is justified. For example, a business that uses the FIFO, first in first out method for the inventory valuation for 1 year should continue using the same method for the next upcoming years for the consistency principle. Matching principle says that expenses should be recorded in the same period as the revenue they help generate. Ensure that income and related costs are reported together. For example, if company provides services in December month but does not receive payment until January, so matching principle says that it should be recorded the revenue in December when the service was performed along with the related expenses, right? It means, for example, in the car dealership, commission is due but not paid. Uh, for example, the salesperson have sold 5 car. By selling 1 car, $1,000 is the commission in the month of December, and 5 cars were sold but money is not paid yet. So $5,000 will be considered as the commission expenses for the company should be recorded in that particular year or that particular month, and it should be recorded on the profit and loss account debit side. Whether this is paid or not, it doesn't matter because it matches with the revenue in the month of December which was generated. Materiality principle says that all significant financial information should be reported in financial statement. Which information? Significant. All significant financial information. That is very important part. And mirror or the trivial, minor or trivial means very small items may not need to be recorded if they won't affect the decision made based upon the statement. So materiality, for example, if a company has a small office supply expenses of $50, it may not record this detail separately, but instead lump it into journal office expenses account due to its immateriality. It's not so material, right? And on the other side, if I say Elon Musk is CEO of Tesla company and having their own personal issues or small things happening in their personal life is not going to affect, it's not material for the company. But on the other side, if he's going to uh, start a new venture, going to open a new office or big unit, then definitely it is going to be affect the investor's mind. Investor may invest more money in his company. So that is materiality principle. Objectivity principle says that the financial report should be based upon the objective evidence, mean facts and figures, not personal opinion or biasness, not subjective. The information recorded should be verifiable and supported by some documents. If the sale that you are reporting for $10,000, there should be a sale invoice. If the company purchases a building and price it pays will be supported by the purchase documents, contract, or legal documents, which can be objectively verified. So this is objectivity principle. Conservatism principle. When faced with uncertainty, the company should recognize expenses or losses and defer recognizing revenue or gain until they are realized. So what does it mean? I'm just going to explain with one example. If the company expects a potential loss of $100,000, it will recognize expenses immediately. However, if the company is expecting a gain from the selling an asset, it won't record the gain until the sale is complete. So there is a two different things. If in case there is a loss, then it will be recognized immediately. If in case of there is a gain from the selling of the assets, no need to record until is made. This is known as conservatism principle. I can give one more example. If the stock value today, let's say Best Buy have bought a 1000 you can say laptop or mobile phone. Let's say mobile phone 1000 mobile phone at the rate of 500,000, at the rate of 500 each. So the total cost is $500,000. Due to the new model come up in the market, then the price has dropped to 450. There's a loss of $50,000 because 50 into 1,000, $50,000 loss. So the company can record this loss in the profit and loss account and also reduce the inventory from the $500,000 minus 50,000 is $450,000. So that $50,000 is considered to be a loss even when the product is not sold. So this principle says conservatism principle. Full disclosure principle: all the relevant and necessary information must be disclosed in the financial statement to help user make informed decision. This include footnote or additional explanation if required. For example, if a company is involved in a pending lawsuit that could significantly impact its financial condition, must be disclosed this information in the footnote of the financial statement. This is the full disclosure principle. Revenue recognition principle says that the revenue should be recognized when it is earned, regardless when the cash is received. For example, the company has sold goods on credit and the goods are delivered to the customer's place, but money is not received. Even then, revenue is recognized. A company delivers goods to the customer in December but does not receive payment until January. It should recognize the revenue in the month of December when the goods were delivered. So all these principles are the fundamentals in ensuring the accuracy and transparent financial reporting. So I have explained all accounting principle, most important, the 12 accounting principles with examples.